Thanks for having me. So I'm Juan Herreno. I'm an assistant professor of economics at the Department of Economics at UC San Diego. And today I'm going to be talking about the geographic effects of monetary policy, which is joint work with Mathieu Pedemonte from the Federal Reserve Bank of Cleveland. So what I'm going to say doesn't reflect the views of the Cleveland Fed or the Federal Reserve System in any way. Okay, so the question that we try to answer in this paper is, what are the effects of monetary policy actions across differential labor markets in the United States? And the message that I'm going to try to convey is that the same monetary policy action, let's say a tightening of interest rates, creates very unequal effects in the cross-section of metropolitan areas in the US. So employment and prices tend to react way more in some areas relative to others. And in those areas in which employment and prices reacts by more, end up being the poorer metropolitan areas in the United States. So the main message of the paper, again, is that these monetary policy actions create very unequal effects. So in the areas where employment falls by more are also the areas where prices fall by more. And these metropolitan areas are poorer areas in the United States. So in the richer metropolitan areas in the US, after the same monetary policy action, policies react by less, and employment almost doesn't react. So these differences not only hold for the whole expenditure basket of consumer price indexes, but they also hold for more narrow consumer expenditure categories. For example, food at home, food away from home, shelter, and even very tradable prices like gasoline, but they're larger for expenditure categories that have larger non-tradable components. These differences are not only statistically important, but they're economically important. So if you were to compare the price effects of metropolitan areas that happen to be the poorest metropolitan areas in the US, the 10th percentile in the income distribution, those effects on prices are 50% larger than the national average. And the peak employment responses in those areas are twice as large as what you would see in the aggregate economy. So let me show you how that looks in a couple of figures. So here I'm showing you in the left panel the responses for employment after an increase in interest rates of 100 basis points. And on the right panel, I'm showing you the same responses, but for prices instead of employment. What you see here in black is the average response of the US as a whole in terms of employment counts. And what you see is that the peak employment responses in poorer areas in the US are twice as large as those as in the average, and in the richer areas are very negligible. Now, if you flip the coin and you look into prices now, you would see that the price responses in the rich areas are very mild, but the price responses in the poor areas compared to the average are quite substantially larger. So this is, of course, an important distributional aspect of monetary policy. We tend to think that in normal times, monetary policy authorities have only one tool at their disposal, the policy rate, but their actions create very differential effects on space. Now, these effects in which you observe a positive movement in areas in which you observe larger price responses and employment responses at the same time can be explained in a simple model by differences in the slope of local demand curves, but they're inconsistent with differences in the slope of local supply curves, for example, in the slope of the Phillips curve. Now, this heterogeneity in demand curves create amplification of aggregate monetary policy effects. So if you have more unequal regions in the same country, the same monetary policy action is going to create larger effects. And of course, creates important margins for redistribution. After the same monetary policy action, some regions are going to consume more, some regions are going to work more. So to understand the transmission mechanism of monetary policy, we think that these insights are very important.